Thank you for joining us today. We're going to go into some in-depth illustrations, specifically into the college funding and some of the nuances that go with that. So we're going to specifically work on National Life Group because we feel they have a really strong platform when it comes to their product. So let's dive into it. When we go into the National Life illustrations, as we know, we go into the new illustration and we're going to be using the FlexLife product. So make sure you choose a FlexLife that says LSW because we're independent agents. Do not make the mistake of choosing NL, which is a National Life product. That's for the captive agents. So make sure you're always choosing the LSW FlexLife product. We'll land on there. And today we're going to show you two different ways to run these illustrations. We're going to first show you how to the parents, and then we're going to focus on the alternative solution of doing it on the child. So you can kind of see the differences between both of those, okay? It's really up to you how you want to structure it for the clients, but you'll see the differences. Ideally, you want to do both. If you can sell one to the parents and to the child, it's even better, but no, sometimes that doesn't happen. At least you can give them an option. So when working with these college funding potential clients, you got to think about who your target market is. You want to try to focus on people with younger children because this tends to work better in that aspect, unless you can really get those potentially older kids that are willing and the parents willing to put a lot of money towards IULs. But this works best when you get them young, so it gives them time, right? Time for that money to grow and grow over your younger years until they graduate high school and then go on to college. So we're probably looking at a parent that's going to be probably either in their late 20s to 30s, potentially 40s, depending how late they wait to have kids. But for this example, we're going to choose probably somebody in their early 30s to kind of give an example of how this works. So we go here and we can just enter an age. Let's just do age 30, kind of right in the middle, all right? And hopefully, typically in those younger years, we're going to have a healthier type client. So let's pick somebody who's a preferred non-tobacco. So we're going to go there. And let's go to death benefit and funding. So the idea with this is we're going to try to max fund these IULs to get the most cash value for the least amount of death benefit. Okay? So we're going to switch it from face solve type of none over to minimum death benefit and maximum cash value. So as you can see, it's going to grade this portion out here so we don't have to enter a death benefit. The system will auto-calculate that death benefit for you. And then in a couple of minutes here, we're going to look at death benefit options. We're going to compare level versus increasing. But for now, let's leave it at level and see what the option comes out first. Okay? So when we go to premium, we want to make sure we change it over to a monthly because that's what typically most people end up paying is on a monthly basis. And we're going to switch it over from a target premium order to specify. So we have to tell the system what is it that we're trying to accomplish with this college funding strategy. In this situation, we're going to focus on combining not only what the money they're willing to pay to save for college, but also what are they willing to pay themselves to plan and save for retirement. So hopefully we can get a higher contribution into the IUL to really max fund a policy. Okay, well, in this situation, we're going to look at doing, let's just say $1,000 a month, because let's just say we can put $500 towards their own personal plan. They're going to put maybe $300 towards the college savings. And then this is an extra $200 because they chose to maybe not max fund their 401k and just only get the match, so they can put a little bit extra into this plan. So the goal is to really max fund it as much as possible with as much cash to really see the value and growth in this solution, okay? And let's just put this through retirement age like we always do. So we start with year 1 dash through age 65. And that's what the A65 means, is through age 65, okay? And we're gonna pause here. We're not gonna go down to distribution just yet. We're gonna go to a quick view, take a look and see what our cash value looks like so we can kind of get an idea of how much money will be generated by the time our kid goes to college. So we go to quick view. We can see here that the policy will begin at a $1.3 million death benefit. You can see the protection is there for the family, which is a good thing, right? You want to protect the family in case something happens to the breadwinner. And then we scroll down, we take a look and see, let's assume that the child, let's say it's a 2-year-old child, okay? So that means that they'll be going to college in 16 years, okay? So you can see here that in 16 years, the cash value in this policy is $231,000. So that's a pretty good chunk of money to use when it comes to paying for college. However, something that's important to note and good information to tell your client is whenever you use these policies for college funding, you don't want to necessarily use it when they go to college. You want to start using the money from the IUL after they graduate college. Why? The main reason why is whenever you're applying for college, you always want to try to maximize any federal aid that the government's going to give you through the FAFSA form. Okay, that's what the government form is required for you to get any type of financial aid from the government or from the state. If there is any money sitting in a bank account, that counts against any type of federal aid. So for example, if you were to take money out from the IUL before you go to college and put it in your bank account, that's going to count against you. Even though it's a loan from the IUL, if it's sitting in your bank account somewhere, they're going to see it and they're going to count it against you. So the strategy to use for college funding is to use the money from the IUL after they graduate so you can maximize any types of federal loans, any type of financial aid while you're in college, and then use the IUL money to pay off those loans, because typically you can have a better rate from an interest rate from the IUL than what you would get whenever you're trying to get these financial aid loans. So if we look at those numbers, let's look 4 years after that, once you graduate college, was this year 20, because now the child is 22. Look at the cash value here. So over this 5-year time frame, your cash value grew from $231,000 to $340,000. That's a significant amount of gain over just 4 or 5 years when it comes to this policy, enabling you to maybe pay off more of those student loans than having to take money out throughout the college years of $231,000 versus $340,000. So that makes a big difference when it comes to that. So now we're going to switch back over to death benefit and funding, and we're going to show the client what that looks like if they were to take money out to pay back some student loans. So now we're going to go to the distribution portion of the illustration software. We're going to switch from monthly distribution to annual. And on here, we're going to specify. Let's just say we want to take out $100,000 from the IUL to help pay back some of those loans. You want to do that, we said, is in year 20 after they graduate. So the way you do that is you put year 20-20, because that's the year you're going to take out that $100,000 to help pay off those student loans. Okay? And then we also want to show, well, what if this were to be used for retirement as well? Okay, because that is also part of the design within this solution. So we know that we stop paying money into this policy at age 65. So let's solve for income on our next one. So we're going to add a row, and we're going to solve for income. And now we're going to specify that we want that income to begin at age 66 through maturity. So that's A66-M. So just to kind of recap what we're doing here, we're telling the software to calculate how much cash value will the policy generate if I'm able to put in $1,000 from the first year of the policy till I'm 65 years old. Then I want to take out $100,000 as a loan to pay back the student loans in year 20, but then also want you to calculate how much income will I have annually at age 66. So now I go back to Quick View and we'll take a look and see what comes out. So your death benefit still remains the same at $1.3 million. But now in year 20, you see that we have $100,000 that we use to pay back those student loans. And then we scroll down and we can see at year 66, the potential income that we have for retirement purposes at $96,000 of potential annual income from this policy. And look at the cash value that's in here at this point in time of retirement, almost $1 million. That's the beauty of having this type of plan where you really max fund it at an early age to not only save for yourself as a parent, but also save for your kid for retirement purposes. I mean, for college funding purposes as well, okay? But now I want to make a little tweak in here so you can see some differences. Let's go back to death benefit and funding. And let's take a look and see what if we were to change the death benefit, instead of making it level, we change it to increasing. What increasing going to do is going to bring down the death benefit, so you're not getting as much life insurance early on, and then it grows over time. Let's see how that impacts all of our calculations that we just did. So now, the first thing you're going to notice is our face amount dropped for $1.3 million down to $554,000. So the cost of insurance is lower early on in the policy. What you're sacrificing is that life insurance protection, which is important. When you're young, 30 years old, you have some young kids, you want to make sure that your family is safe and protected. So that is a potential risk. Doing increasing, you are lowering that protection when they might need it most. But it does bring the cost down to hopefully generate more cash value. So if we go here, you can see that it's about the same. When we look at the cash value, it comes out to about the same over time in year 20, and they still take that $100,000. But now we took a look and see our income stream at age 66 dropped from about $96,000 down to $87,000. Why is that? Well, because now the cost of insurance is increasing every single year as we add on more protection throughout the years. And that's the challenge when it comes to increasing, that over time, that cost has increased and it does take away from that potential gain. So it's really up to you how you want to structure the plan. You know, if I were to make a recommendation for this client, I would probably say we want to keep it level. We go back to doing that. You'll see here what we do with this is able to provide them more life insurance protection at an early age with $1.3 million of protection for this family, which God forbid something happens to them, their family gets that lump sum and they're protected and have some money to pay, hopefully the home off, pay for college and have some money left over. But also it generates just very similar type cash value within this program over the time frame. Okay, so this is one strategy to use for college funding. Okay, the second one is, what if we did the life insurance on the child instead of the parent? See how those numbers differentiate. Let's go back here and let's create a new product illustration. Pick the FlexLife LSW. And now let's put the same child, but he's 2 years old. Okay. There we go. Whenever you change it to a child or a juvenile, you only have two options when it comes to rate class, either standard non-tobacco or express standard non-tobacco. You're not going to get a preferred rating for a juvenile or a preferred plus. These are the only two options when it comes to here. Okay. And then also, since they're a juvenile, there will have to be a parent to be the owner of the policy, which you would have to enter that down here as an owner. And you'll see it automatically opens up for you whenever you enter a juvenile here. Okay. So now let's go to death benefit and funding. And let's do the same kind of situation we talked about last time, except we're only going to put in the money that we're going to use to pay for college. So we're going to put minimum death benefit, max cash value, and we'll play with the level and increasing in a minute. So let's leave it at level for now. We'll do premium mode. Let's do monthly. And let's change it to specify amount. And in this situation, let's do $300 a month, okay, between now and the time they graduate college. Let's put age 22, okay? And then we pause and we go to quick view and kind of see what those numbers look like. So in this situation here, the child had a $1.1 million policy. Seems a bit high for a 2-year-old, okay? So we have to play with those numbers here in a minute. But you'll see here, at age 22, about $97,000 of cash value at that time, okay? But now let's just say after they graduate college, now they're hopefully get a job and they can continue to contribute towards this program. But at this point, let's just say they can put hopefully a little bit more money because they're really thinking about using this program as a way to save and plan for retirement. So now let's put age 23 once they graduate college. Let's put it to age 65 until they retire, okay? So the parents maybe pay for it while they're in school, but then after school, they're able now to put some more money themselves, help them plan and save for retirement, okay? We go to distribution. Let's do annual here. Let's go to that specify amount. Let's put in that $100,000 like we did last time. Let's put it at age 22 after they graduate school. And then let's also put in the solve for income. Let's put it at age 66 whenever they retire through maturity. So recap again. What we're trying to do here with this program is with this 2-year-old child, we're going to maximize the value. We're going to pay $300 a month between now until they're 22 years old. After they graduate college, continue to pay into the policy at $500 a month from age 23 to age 65. And in the meantime, we're going to take out $100,000 to pay off our student loans at age 22, then hopefully receive a stream of income at age 66 until maturity. All right, now let's do a quick view. Let's take a look and see how this program pans out. Oh, wow. So now we can see the face amount jumped to 1.6 because of the $500 a month we're putting in after retirement. After graduation. So by doing that, though, now the cost of insurance has gone up significantly to where it is too much to sustain. So now that cash value has gone down. And then we see our income is $158,000. That looks great, 65 years from now, but not so great 20 years from now. So what we're going to do is we're going to go back to death benefit funding and make one tweak. And that tweak is changing the death benefit option from level to increasing. Since they are so young, at 2 years old, the cost of insurance will be significantly lower by doing increasing. It also allows us to lower the death benefit early on to allow for that growth over time. So you'll see that this may be the better option to do increasing versus level at such a young age. Let's see if that's true. We'll go to quick view. Go back here, and we'll see now death benefit has dropped down to $706,000, much more manageable. Okay, that makes sense versus a $1.6 million life insurance policy for a 2-year-old. And then we'll see here the cash value has grown to the $100,000 like we anticipated. So at this point, they can take out that $100,000 and pay off those student loans. But now we're starting to fund it at $500 a month, $6,000 a year after I graduate college. You see here, keep going, keep going. Now our income, potential income, is $184,000 tax-free every single year in retirement. And the beauty of having an increasing is, what you'll notice on the death benefit side is, the death benefit increases over time, which as a parent and as an adult, you want to have that protection for you and for your family. So over time, you have this increasing death benefit that benefits your family if, God forbid, something happens to you. If it doesn't, you have the potential income here. So this really depends on how you want to structure this program. You want to either do it on the parents or the child. Ideally, you can do both, right? So there's protection across the board. But one thing to note when it comes to National Life, when you're doing these types of proposals, is you want to make sure that if you do offer it to the child, there has to be life insurance on the parent. You cannot insure a child if the parent is not insured. It has to be at least the same amount of life insurance on the parent as is for the child or more. So in essence, you cannot sell this policy to a child if the parent has less than $700,000 of life insurance. Okay? It has to be at least $700,006 or more to be able to sell a program like this to a child. That's where you get able to sell this solution to the parent in addition to the child. Okay? So these are the two ways that we can use to help provide illustrations for college funding for a child and or an adult.